Howdy, folks. Welcome to the program, Dollars and Cents. My name is Joel Garris of Nelson Financial Planning. Hey, you're listening to a show that was recently named one of the top 25 financial planning podcasts on the World Wide Web. Pretty cool, right? So if you're not catching us live here on Sunday morning, we encourage you to subscribe to any of our channels that are out there on the various social media platforms so you can kind of listen on in along the way. Maybe you're running. I've got a running tie on today. We'll talk about more as to why that's the case. Or if you simply want to maybe see my running tie, you would subscribe to our YouTube channel. Just look up Nelson Financial Planning. As always, we've got a packed show. We're going to talk about some new scams that are out there. This time of year, those scams have a tendency to increase as we go through tax season. So we want to give you some alerts on some of the newer ones that are out there so you can be aware of them and hopefully not fall prey to the criminals that are out there. We'll also talk about some of the things that you need to do along the path to retirement. What are some of the things that you need to do 5 years out or 2 years out to set yourself up for the best possible retirement? We'll talk about that on the program, along with some other topics that will sprinkle in along the way. So if you're like me, you've certainly gotten the calls before on your phone, and most of the time it's kind of obvious, right? I mean, phone rings and then there's sort of a long pause and then someone starts speaking and they claim they're from the Social Security Administration or maybe the IRS. And usually they've got some kind of an accent. And that's kind of one of the first tip-offs. But it happens so frequently. So just this past week, happened to me. And I said, you know what? I'm going to play along with this and just kind of see where this goes and kinds of questions that they ask so that we can share it with you on the program so that hopefully it'll help you become a bit more informed as to what happens on these calls. First and foremost, the IRS, the Social Security Administration, they don't just randomly call you out of the clear blue sky. That does not happen. So set that aside. The IRS is not going to call you and say, if you don't pay within 24 hours, you're going to go to jail. The Social Security Administration does not call you and say, we are freezing your Social Security number in these circumstances. They don't do that. That's not how it works. So, but the reality is these guys are pretty good. These are professional criminals that are on the other end of the phone. So when my phone rang this past week, I was driving into the office, although I don't think I'm supposed to answer. I don't know what these rules are with the phones. Maybe I'm not supposed to answer the phone when I'm driving. Anyway, I answered the phone. And it was one of these guys. And I said, well, I've still got another 10 minutes to drive into the office. I'll give it a shot and engage a little bit. What was interesting is that they knew my name. And obviously they knew my phone number. And they knew what city I lived in. Now, here's the thing. The conversation started out with, hello, we're the Social Security Administration, and there's a problem with your Social Security number, and we understand that you are Joel Garris, and you live in Orlando, Florida. I mean, that's pretty good, right? So right there, you sort of let your guard down just a little bit because they're identifying who you are and where you're from. Of course, the reality is that that's information that's pretty public. I mean, you don't have to do a big search online to be able to find out what my name is and where I live and connecting that to my cell phone number. That's what they do, is they do a lot of online searching, a lot of searching on social media, a lot of searching on the internet in general, and they can find out that information. So, again, playing along. Finally, they get to the real meat of the, here's, they're trying to set the hook, if you will, on the fish. And they said, what is the last four of your Social Security? And I guess in hindsight, if I really was playing along, I should have given him like a different set of four because then I would have been curious about the next set. But next time, I'm going to do that. I'm going to make up random four digits. I'm going to see where that takes us. But anyway, I decided to say, well, wait a minute, where are you calling from? And they were quick. They had a good answer. They said that they were calling from the Social Security Administration office in El Paso, Texas. And I'm like, well, that's pretty good. I mean, again, these guys are good. And and then it finally dawned on me, okay, I can play along. I said, El Paso, where in El Paso is your office located? Because my parents were born there. Now, my parents weren't born there, okay? But I figured, yeah, let's throw it out because clearly the guy's not sitting in El Paso, Texas. And lo and behold, I then got a big click. So the conversation ended. I wasn't able to get further. But next time, I'm going to play along. I'm going to give four random numbers, and we'll keep you posted as to what happens. That'll probably happen this week. I mean, as often as this stuff calls. But here's the thing. Particularly during tax season, as we get into tax season, the amount of scams increases dramatically. The folks at the IRS, a couple of weeks ago, issued out sort of the latest warning of things to watch out for. And one of the things that is out there is that there's sort of a new version of the Social Security number scam. So be very careful in this. Every year, they're going to kind of adjust and modify their approach because as people get wise to sort of their prior approaches, they're going to adjust and modify that. So the IRS is pretty good about issuing out warnings to taxpayers. We urge you to just be careful. When you get a call, it's not going to be the IRS. It's not going to be the Social Security Administration. You want to play along just for fun, great. But understand that these people are very, very good, and they may trick you into giving up something that you do not want to give up. So best advice, if it's one of those calls, just hang up. They're not going to call you. They're not going to call you randomly. Speaking of that, the Better Business Bureau also recently issued out a new scam alert, and this one involves getting a text or getting an email from the folks at FedEx. And what that is saying is, well, there's something wrong with your delivery, and in today's world, right, we're all getting deliveries, particularly because there's this company called Amazon that drops them on our doorstep like every 5 minutes, depending upon how frequently you order from them. And so this particular scam that the Better Business Bureau is warning about has to do with getting a text, getting an email from FedEx that says there's something wrong with your delivery. If you click on it, it will immediately direct you to an Amazon-looking site where it simply asks you to verify your credit card information. And there lies where the problem comes in. That is not legitimate in any way, shape, or form. Don't respond to that. Folks, it's so important. It's so crucial. This is such an important issue that even at our office, we have a system, a training program that exists in the background where we're constantly tested as employees to help spot and identify fraudulent emails. And on a regular basis, we have to take certifications to help increase our knowledge on how to spot these and how to ignore them. This is a big problem in society today, and just be careful. Now, there are some that are so good that when you look at them, you think, wow, that's pretty good. And we had one of those just this past week. So client comes in, longtime client, and we certainly appreciate when folks bring this to our attention because it allows us to share with you on the program so that perhaps you do not become victim to it. So again, this is where if you're one of our YouTube subscribers, you get to kind of see what it looks like. We're going to hopefully do this as best we can over the radio. So it starts with this. You get a fancy express envelope from UPS. Pretty cool, right? It's got your name on it, or it had this person's name on it. And you open it up, as this person did, and you pull out a very official, holding it up to the camera, very official looking check. I mean, this is the real thing. It's got the kind of the markings on the back. Okay. It's got the right thickness. It says original document. I mean, this is the real McCoy. Okay. And so this individual handed it to me, and I looked at it, and she's like, I don't know what this is, but I think it's a scam. And I looked at it, and I was like, I mean, this looks pretty real. Got some account numbers on it. Got a bank on it. It says cashier. I mean, it's definitely, definitely printed on the right paper. I was like, it's still just kind of funny. And then I happened to look inside the envelope a little bit more. There it is. And found this little piece of paper. And this little piece of paper, first of all, it's not cut straight, right? See that? See how it's not cut straight? It's cut like almost like a 3-year-old did it with scissors. See that? And then it doesn't really read right. There's some spellings, there's some up and down, and it says hello. You can see where like the is capitalized. Hello, the check you received is for the promotional drive innovation campaign job you applied with promotional program by Dr. Pepper. See, it doesn't even read, please text blah, blah, blah with your full name and check number to confirm your package. Thank you. Pretty legitimate looking check. You got a fancy overnight envelope. Boy, it's always cool when you get these, right? I mean, there must be something important in here. The check. Here's the thing. It's not legitimate. And it takes a while to figure it out. But the reality is that this is your key. This is your tip, okay? That it's not cut straight and it's not really written in proper English, and it's got some funky use of punctuation and capitalization. The reality is we sat there then for another few minutes, and I said, well, how did you even get involved in this? How did you even kind of get hooked into this? Where's this coming from? And we kind of thought about it. I did a Google search and realized that this was a scam that talks about, there's actually a YouTube video about a news station that identified this. And they said that what this is you see an opportunity pop up on the internet that says, do you want to wrap your car? You can make hundreds of dollars every month if you wrap your car with the Dr. Pepper logo or the Coke logo or whatever the logo is. And the reality is it's not legitimate. And what happens is when you cash an illegitimate check, you are actually responsible for those dollars. So the scam is pretty intricate in that it looks like an actual real check, and it is. The problem is, because it's a fraudulent check, you cash it, you become the one that's responsible, and they then show up your house to wrap the car, put a little sticker on, and then they collect a large portion of this check as the fee for installation, leaving you with a little bit of money. The problem is then that you just handed them cash, and now you're legally obligated for that cash. So that's a little bit more intricate, pretty intricate, and looks correct. But again, just bottom line, fight against everything that you might be thinking when you get something like this. When you get a call or when you get a package, just assume that it's fraudulent. Do some searching, do some checking. Nobody's sending you random checks in the mail for thousands of dollars so that you put a Coke sticker on your car. I mean, just stop and think about it a little bit. And folks, be careful about what you fill out on the internet. This came as a result of somebody filling something out randomly on the internet. Oh, this looks cool. This looks fun. I'm going to make some extra money. And this is what happens. And very quickly, then you can fall into a significant trap. So beware, especially this time of year with tax season rapidly upon us. Those scams have a tendency to increase incredibly during this time of year. So be very, very careful of those. I'm sure along the way we'll have more updates as we do from time to time on the program about the latest scams. But bottom line, be careful out there, folks. We're going to take a break. When we get back, we will continue the conversation on some things to be thinking about as you get closer to retirement. All that and more here on the program. This is Dollars and Cents with Joel Garris, Nelson Financial Planning, News Radio, WFLA. Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. Just recently named one of the top 25 financial planning podcasts on the World Wide Web, thanks to the folks at FeedSpot. So if you're not catching us live, be sure to tune in on the various social media channels that are out there. Plus, when we do like colorful presentations, like showing you the fraudulent check that a client got this past week, you get to see that if you're looking at us on YouTube. So be sure and check us out there. Also mentioned early in the program, we're wearing a running tie today. That's because next week we will not be live in the studio. We're actually going to be taping a program this week, which we don't normally do here on the program. Most of the time we are live in studio. This week we will be taping for a couple of reasons. First and foremost, we have our first of 2020 client meetings on Wednesday, and every quarter we have these meetings that we invite our clients to on a regular basis. And so our speaker, our featured speaker, which we're pretty excited to have, is Dr. Sean Snaith, who is the director of the Institute of Economic Forecasting out at UCF. If you've been kind of watching the news of late, he has appeared on News Channel 13 this past week and was featured on the front page of the paper in terms of a study that he did on behalf of the airport authority. So pretty well-known guy, and certainly very excited that he's local as well. That makes it easy. But anyway, he's going to speak to our clients on Wednesday, and then Thursday or Friday, not sure which day, still slightly up in the air, we're going to come into the studio here and tape the program. So next week, very excited, conversation with Dr. Sean Snaith of UCF Institute for Economic Forecasting, and that will sort of be a continuation of the presentation that he made to our clients on Wednesday night. So if you missed the meeting on Wednesday, at least you'll have an opportunity to hear from Sean on Sunday morning. And so that works well for his schedule because not everybody can kind of make a Sunday morning. The other reason, of course, and back to why we're wearing the marathon tie, is we are running a marathon next Sunday. So cheer us on, and hopefully we'll be able to finish. It's our second one. We started this last year, ran the Disney Marathon. This year we're going to run the Florida Marathon over in Melbourne, hopefully trying to do a little bit better than we did last time. That's always the case. We'll see. And so hence we are wearing the marathon tie. Also next week, Super Bowl weekend. Sadly, Patriots will not be participating, but the Super Bowl is in Miami. At some point during the course of the program next week, we'll have to talk a little bit about the Super Bowl indicator, right? We can't have a Super Bowl Sunday pass without talking about the Super Bowl indicator, which is kind of one of those tongue-in-cheek little silly market indicators, if you will. I have to ask Sean who he thinks is going to win the Super Bowl as well. So all that on the program next week, so that's good stuff. And one of the things that we wanted to actually hit in this particular segment was the Secure Act. We've talked about certainly at length. The fact is that it has eliminated the concept of the stretch IRA. Remember, though, that the exception, though, in the Secure Act exists for spouses. So spouses still have a choice as to how they want to approach in getting an IRA or inheriting an IRA when their spouse passes. And there's two key distinctions to be thinking about in this situation that spouses have as an option. They can either treat the account as their own. Okay, so if your spouse passes away, you can basically take over their retirement account as your own. You are the only person that can do that. That's an option that's only available to a spouse of an individual. So you can take that over, step into the shoes, pretend like it's your own, and that's one option. The other option is that you can set it up as a beneficiary IRA, and the old rules of the stretch over the course of the rest of your lifetime would still apply in that situation. And so now you've got a beneficiary IRA. So why would you want the spousal one versus the beneficiary IRA? Well, it really depends upon how old you are and what you're trying to accomplish with that account. So let's say that your spouse passed away at an early age and you're not quite 59 and a half, but yet you need access to that money because if you just lost a spouse, you probably also just lost some income. And so consequently, you need to make sure that you have the ability to access that money. That's one of the biggest reasons why you would want to set up that inherited IRA from a spouse as a beneficiary IRA. And the 10-year rule that now exists does not apply. The exception is for spouses. So then you could actually utilize that account, take money out of it as you needed, and you would not have to worry about a penalty for early distribution. Remember, a beneficiary IRA, there is never a penalty for taking that money out no matter how old you are. So the beneficiary IRA would provide some flexibility whereby you could use that money and never have to worry about a 10% penalty. On the other hand, with a beneficiary IRA, again, for spouses, the old stretch rules apply. So you would have a required distribution that you would have to do each and every year. Well, if you don't need that income, then maybe you don't want to do the beneficiary IRA. So that would then steer you back to the spousal IRA. The other thing about that spousal IRA option, where you basically assume it as your own, is it then becomes your own and it's subject to what your age parameters would be. So again, if you need access, you're under 59 and a half, that's not a good decision because now you made that account subject to the 10% penalty should you need that money. So one of the things that you might want to consider is taking one IRA and maybe doing it as a spousal and then another IRA and doing it as a beneficiary if you have that flexibility. Remember, when you take an IRA as your own as the spouse of someone who passed, then the rules that would apply individually to you are going to apply on that account. So things like required minimum distributions at 72, new age now, and being able to avoid the 10% penalty have to be over age 59 and a half. So some important distinctions with respect to a retirement account and how that plays, particularly if you are the spouse, and of course, how that also relates to under the new rules of the Secure Act. So some important things to be thinking about when it comes to a retirement account and inheriting a retirement account. Certainly the Secure Act, in changing those rules, really is going to generate a lot more thought and planning that needs to be done as it relates to when you inherit an individual retirement account or a retirement account of any kind. So some important things, an important distinction that we just wanted to take a few moments on the program and talk a little bit about. We're going to slide to a break because we're at the bottom half of the hour. So we'll slide to the break, and then we will start the conversation of what are some of the things that you need to be aware of when it comes to planning your retirement. At what years out do you need to start working on different things? We'll have all of that and more when we get back here on the program. Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio, WFLA, Orlando. Recently named one of the top 25 financial planning podcasts on the World Wide Web, thanks to the folks at FeedSpot. This is Joel Garris, and we are talking in this segment about some of the things that you need to do in the years leading up to retirement. The last thing you should be doing is waking up and saying, okay, I'm going to retire tomorrow. What should I be doing? Not sure that's a good strategy. There's some things that you want to be doing along the way to try and prepare yourself as best as possible for what retirement is going to look like. And it should start, well, it should start really when you're in your 20s planning for retirement. But when you're wanting to put a retirement plan in place, it should certainly start at least 5 years before you actually retire. And particularly at sort of that 5 year mark, there are certain things that you really want to be looking at and thinking about. And it really has to do with making sure that your debt is in good shape when you're going into retirement. So, probably one of the key things to be looking at 5 years out, along with sort of taking a snapshot of where you are on the asset side of things, you really also want to be taking a look at the liability or the debt side of things and really reviewing how much you owe, who you owe it to, what the interest rate is it fixed, is it variable, and then from there, make a game plan as to, okay, which of this needs to get taken care of, paid off, before I retire. And that's really important a few years out from retirement because it still gives you time to address that debt and to pay it off. Also, 5 years out, you want to be looking similarly at sort of those cash reserves, right? It's going to be important when you go into retirement to have some baseline level of emergency savings cash reserves that you can use on a extreme basis as an emergency fund. You also want to be looking at whether you have the ability to set up a non-IRA or a non-retirement type of account, something we refer to as a regular investment account, because those types of accounts are going to be able to be accessed with much lower tax implications than if you were to be drawing a chunk out of your retirement account. Traditionally, you almost want to think of it this way. I get my regular monthly income that I need to cover my expenses from my retirement accounts. And then I have my other accounts, my regular investment accounts, where if the roof leaks or I need a car or I want to take a fun trip that's beyond the norm, then I have that account where I can grab those chunks out, and ultimately that money winds up being taxed at a much lower basis. Remember, a regular type of investment account, you put the money in on an after-tax basis. The only thing you're responsible when you take it out for is the appreciation, which is the capital gain, and then you have to pay tax on that. Tax on that, maximum rate for the vast majority of people is only 15%. So that's a much more tax-efficient way to grab chunks. It doesn't throw you into a higher tax bracket. So that's kind of traditionally the way to look at it. So that's why it's important to kind of look at the overall picture of the assets, understand the nature of those assets, particularly from a tax perspective, but also very important 5 years out to be looking at the debt side of things and making sure that that's going to be in good shape when you get to retirement. So that's 5 years out or so. So as you get closer, a couple years out from retirement, you really want to then kind of review things, start to review things in much more greater detail. Specifically, the cash flow projection numbers. Where's the money going to come from? How much is it going to be? And what's the tax implications of it going to be? Because back to what we were just talking about, those things that you want to be thinking about 5 years plus out in terms of the tax nature and building up those types of accounts that don't have as much tax nature. 2 years out, that's when you start to kind of fine tune, okay, here's how much income I'm going to get from my retirement accounts. Here's what's available in my cash savings or my regular investment accounts, and then sort of combine the two to make sure that you've got a good tax strategy that's intertwined into this amount of income. Because here's the deal. In retirement, hopefully you don't have a debt expense, so that is good. If you don't have a debt expense, your two biggest expenses that we see on a regular basis are going to be Uncle Sam and your health care. Those are going to be your two biggest expenses that you have to face in retirement. So it's so important to plan for the IRS in the mix of things, because that is money that when you're taking money out in retirement, generally you're going to take some money right off the top, much like your paycheck, right? Your paycheck, you don't get all your paycheck. A chunk of it goes off to the folks at the IRS. The same thing is going to happen in retirement. So important to start to kind of look a couple years out from retirement at those cash flow numbers, those net numbers after you've interlaid on the tax impact of where your income is coming from. Another good thing to do a couple of years out is to review your estate plan, take a look at that, and make sure that that is all in good shape. Now, as you're getting closer, okay, so a year out from retirement, then you certainly want to then really spend some time sort of buttoning the numbers up, confirming the numbers, reaching out to the folks at Social Security, getting an exact amount of what your Social Security is going to be, maybe reaching out to your HR department, seeing what exactly your pension is going to be, and really fine-tune those numbers precisely. Another good thing to do a year out from retirement is sort of what we refer to as a retirement dry run. Live on your retirement income, or effectively what you would be getting in retirement based upon these other exercises that you've done, and then that gets you a feel for whether that's going to be comfortable. And then ultimately look at projecting where that income is going to come from. Knowing what to do, when to do it, those are some pretty important aspects of having a successful retirement. More, even just as importantly, is understanding the tax implications of the types of accounts that you have, because the tax slice is going to matter when it comes to retirement, and understanding the difference between the different types of accounts. Different ages produce different tax results. If you are under 59 and a half, you've got to be particularly careful when you're using retirement accounts that you don't trigger a 10% penalty. There are some types of retirement accounts, deferred comps, 457s, accounts like that, where the 10% penalty doesn't apply. So one of the things that you don't want to do on those types of accounts is roll them over or drop them into an IRA where the age 59 and a half requirement applies. That doesn't apply on a deferred comp or a 457. So those are the kinds of things to just understand the nature of the accounts that you have, understand the tax nature of it, and make sure that you are being very aware of how all of that plays out. And then also along the way, remember the ages. Remember the ages that are important. Age 50 is when you can start making extra catch-up contributions to your different retirement plans. That's worth an extra $6,000 on a 401k that you could be putting in, that you're eligible to put in once you turn age 50, that you are not eligible to do so beforehand. So know that you can make those catch-up contributions. Great way to sort of boost up retirement savings. Similarly, age 59 and a half, that's a big age to remember. That's the age where no matter what, wherever you're grabbing the money from on a retirement side, there's never going to be a 10% penalty. And then, of course, the last age, which just got shifted, 70 up to 72. 72 is where you've got to take required minimum distributions. Of course, the vast majority of people, 80% of the population that are retired, they're already satisfying their required minimum distribution by virtue of income that they're taking from those accounts. So those are some important ages, and certainly some important milestones as you approach retirement that you want to keep in mind to start to make sure that you're sitting down, getting the numbers in order, and properly planning so that you're not doing it at the last minute. Because if you're doing it at the last minute, you may find, ooh, wait a minute, this isn't going to be as comfortable as I thought it was. So certainly some important things to remember and some milestones to follow, and some homework to do with those milestones as you approach retirement in order to have the best possible retirement plan for your future. We're going to take a break. When we get back, we will continue the conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, listening to News Radio WFLA Orlando. Welcome back to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning. We're the host of Dollars and Cents, recently named one of the top 25 financial planning podcasts on the World Wide Web, thanks to the folks at FeedSpot. Pretty excited about that. This week on the program, we've covered a lot of territory, particularly starting out with the conversation about scams and some of the scams that are out there. Folks, this time of year, the scams do increase because a lot of the scams have to do with your identifying information. A lot of the scams have to do with your taxes, the Internal Revenue Service, Social Security. Right at the season when you're sort of thinking about all of that stuff, that's when the criminals like to strike. So beware of that. The folks at the Better Business Bureau also put out an alert recently about emails and texts involving Federal Express and deliveries, and then ultimately wind up getting rerouted over to Amazon. And then that last one, the check, the perfectly legitimate looking check that came in the mail, ultimately all of those were fraud. So be careful out there, folks, because there's a lot of that goes on, particularly more so this time of year. Also, in the prior segment, we're talking about some of those milestones to be thinking about as you're planning for retirement, whether it's 5 years out, 2 years out, 1 year out. Some important things to be thinking about along the way as you get close to retirement. It's so important to take the time to do the homework, to get the numbers as accurate as possible, and most importantly, to understand what the tax implications are. When you say, "Oh, I need $4,000 a month," or "I need $5,000 a month," understand that you're going to need actually your assets to generate more than that, because if you're saying that's what you need, then you must gross that up. You must gross that up by the amount of the taxes that income is going to generate. And another thing that gets sort of forgotten along the way is with healthcare. Most people have their employer paying some portion, or perhaps even all, if you're that fortunate. Hey, we still do that at Nelson Financial Planning, but many employers don't. And so consequently, you're going to see that you've got to put more of your income towards that health insurance. So you're going to need more income ultimately to cover that change or that increase in expense. So understand the difference of, oh, I need $4,000 or $5,000 a month. Okay, great. That's what you need. That's what you need in hand. Then there's some things you've got to gross that up by in order to get the number that ultimately is going to give you what you actually need on a monthly basis. So that's why it's so important to kind of go through those phases, go through those planning, and to keep kind of revisiting it every year or two as you get closer to retirement, so that you can plan properly for some big expenses, particularly those big expenses of taxes and healthcare. And speaking, of course, of taxes, tax season right around the corner. And so that means it's also funding of retirement season right around the corner. And one of the things that most people sort of forget is that you still have time to fund your IRA or your Roth for last year. Even though we're sitting here in 2020, you have the ability up until April 15th. Now, that's a hard deadline, April 15th, but you have the ability up until April 15th to fund your prior year IRA or Roth contribution. So it's important to know the distinction between being able to fund an IRA or a Roth on a regular basis. And you do have that deadline of April 15th. So understand the difference between the two. The Roth is post-tax money, meaning you don't get a tax deduction for it. And the IRA is pre-tax money, which is one that you get a tax deduction for it. And so maybe that tax deduction is important, and then you need to be doing that on a pre-tax basis. It really depends upon where your tax bracket is, and so consequently, that's some things to be thinking about, particularly in this season where you're trying to make that decision between the IRA versus the Roth, and know that you can fund them for prior year 2019. We're actually going to go to the phones for a little bit. We got Olin from Palm Bay. Olin, how are you? Welcome to the program.
Oh, fine, thank you, Joel. Good morning to you. That was a good, timely segment about the scams that we encounter every day, seems like. One thing that I do, I've had emails where the email has said your Bank of America credit card has fraudulent activity on it. And the tendency is for most people, would be to, jump right on that. I've got to clear that up. I've got to straighten that out. But what I do is look on the back of the credit card. It doesn't matter if it's Bank of America, Target, MasterCard. There's a number you can call.
Sure.
You can call directly to whomever it is. I got one, and I called the number on the back, and it was the Bank of America official, headquarters,
Right.
and told him, I said, I got this notice. There was a fraudulent activity, and they were going to freeze my account. And, of course, the person has all the information right in front of them.
Sure.
And they said,
Sure.
no, that's a scam, sir. And my point is that when you get suspicious notices like that, deal directly with the company, and you can do that, whether it's Kohl's or you can
Sure.
call. They have a
Sure.
number on the back of their car. Call them directly.
No, that's a great suggestion, Olin. And almost, unfortunately, in today's world, you almost have to assume it's a scam, and operate under that.
Yeah, that is so true, Joel, and that's what I've done. You go in there and you want a car or a vacation or something, especially in the spam. It's just it's terrible that there's that much stuff out there, and the reason they keep doing it is people fall for it.
Sure, it's a volume business. They send out, 100,000 emails. All you really need to do is get a dozen people to call you back, and you're in business.
Yeah, but just whatever it is, contact the
Great suggestion.
person. Yeah, because most people, and me included, boy, when I see something like that, I can imagine all kind of terrible
That's
things.
exactly
But,
right. They play on your emotions. That is for sure. Oh, and thank you so much for calling in and sharing that with us. We appreciate that.
Thank you, Joel.
That is some good advice across the board for all of our listeners. If you think something may be suspect, give them a call directly using the numbers that you have. You initiate the call based upon the number that's on your credit card or on your statement. Don't call back the number that they called on, because that's just going to lead you directly to them. But independently verify the numbers. And sadly, as we were saying, Olin, it almost is in today's world where you've got to really keep an eye out and assume that whatever it is that you're getting, whatever it is that this email or this text or this phone call is all about, is fraudulent. And just hang up, look up the right number, call them, and do it directly. That's the best way to avoid it, because they're pretty good out there. That is for sure. So great comments on that. We appreciate you sharing that perspective, Olin. Back to the conversation we were having about the IRA versus the Roth. We want to make sure that folks are aware of sort of where the tax brackets sort of cut, because in our view, whether you do the IRA or whether you do the Roth is really sort of a function of which tax bracket you're in, particularly in today's world where the lower tax brackets are at historically low tax rates. And so if you're at historically low tax rates, that really does bring the Roth more into the conversation, depending upon what tax bracket you're in. As the tax bracket goes up, to do the traditional approach and get the tax savings, there's definitely some value there, because then that gives you extra money to potentially fund even more into your retirement account. But if you're in those lower tax brackets, it's hard not to look at the Roth a little bit differently than perhaps you may have looked at it in the past. In those lower tax brackets, if you're married, filing a joint return, sort of around 100,000 is where your tax bracket then goes from the 12% up to the 22, so 22% tax rate. So if you're under 100 grand as a married couple or under 50,000 as a single person, chances are you're in the 12% tax bracket. And in that particular case, with such of a low tax rate, then that's where the Roth might have a little bit more appeal, assuming that you've got the resources to be able to not have to worry about the tax savings at this point in time. It's important to know where those cutoffs are, because those tax rates, we suspect, won't be with us forever, particularly that 12% rate. So important to kind of take advantage of that as the situation plays out, particularly now with the tax rates being as low as they are. Well, we're going to get wrapped on up and get on out of here. Thank you for listening to the program. We always appreciate that. We appreciate the calls as well. So we appreciate that as well. And we'll be back next week. We won't be back live. We'll tape it because we're running a marathon, number one. And number two, we've got a very special guest that we're excited to have on the program with us for next week. Dr. Sean Snaith will be joining us. He's the director of the Institute of Economic Forecasting at UCF. Super excited to have him on the program. So we will have that and more as we do each and every week. Thanks for listening in to the program. This is Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio, WFLA Orlando.